My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Tom Viktor, who I think a lot of you will enjoy hearing from. Tom, introduce yourself to the audience. Who are you? What's your background? How'd you get involved in trading? And what are you doing currently?
Super. Hey, Michael, thanks so much for having me on the podcast here today in the Spaces. Should be a fun one. So I think I relate with really a lot of the Twitter audience. I'm really similar to them in that I'm a retail participant. I manage my own book, and I've got a focus on technical analysis, really also including sentiment and just general market positioning. So I've been, like most, I got myself naturally involved. I've been in just over a decade, about 12, 13 years in the markets, not managing it all myself the entire time, but probably 6 or 7 years ago, transitioned to really trying to outperform the market and found myself getting caught up in news flow. And I often found that news flow correlated with sentiment transitioning from moments of euphoria to moments of fear. Media tells you, when you're scared shitless and things are falling, don't buy. And they tell you the exact opposite when things are euphoric and fun. They say go shop. And as an early retail participant, I got whipsawed through that, underperforming the market for, an extended duration. So that's really who I am. I write a weekly note, so I've got my own little Substack. So I write a weekly note every Sunday that just shares my thoughts on the general market, where the S&P 500 is going, is the wind at your back, and just my general thoughts on potential positioning and ideas that are coming out.
Are you doing this on a full-time basis, or are you doing other things work-wise?
No, I do other things work-wise. So I guess professionally, I spend most of my time, formerly trained as an engineer, focused on separating molecules and doing really cool things with them in the energy industry. So as a general rule of thumb, you won't hear me talk too much about energy.
Okay, being an engineer, I think is interesting in the context of thinking about markets, because when it comes to engineering, you got to have a very quantitative, scientific type of mind and way of looking at things. I'm curious if you think that your engineering background gives you maybe a little bit of an edge when looking at chaotic systems like the market.
I think perhaps. It's interesting when I drive by, for example, oil refineries or production facilities across the world. I don't look at them as units and vessels. For me, it's reactions and lines that are kind of occurring within those units. So in the same way, when I look at stock charts, I feel the same way. You can kind of start to see the flow. You can start to see the euphoria building up, and so to an extent, I think I pay attention to detail, and I tend to favor the technical analysis piece of it, just because it attempts to remove so much of that human emotion and sentiment that I think most people initially get introduced to when they join the market. It's the news flow that's exciting. Less so for me now. It's much more what are the lines doing. And I laugh a little bit. I call it lines on a chart is what I've titled my Substack, but that's really what it is. I draw lines on a chart, and I attempt to kind of figure out which direction things are potentially going to go for a longer duration of time. And I'll be right and I'll be wrong, but follow me long enough and you'll definitely see both sides.
Okay, so you mentioned that you started 12, 13 years ago doing more on your own. What were some of the things that you look towards to kind of form your way of looking at market, looking at charts? It's more than just lines on a chart. There's deeper analysis that goes into even why the lines are there.
Yeah, I think, initially I just thought it was a cool idea to see the red bars and green bars kind of take shape and understand why they took the shape that they did. And like most, you kind of join in hoping that you can create and formulate the golden goose of, can you find that signal that will tell you when to be long and when to be potentially short or out of the market. Like most, I really just focused on the initial, very basic support and resistance methodology. Kind of as you weave my way through adventuring into technical analysis, you go down different routes. I spent about 2 years studying Elliott wave theory. I don't actively practice it at all, and I actually don't recommend it personally. But I do think there were a lot of really good insights from going down that road, and it actually helped me add value behind the entire sentiment piece. You can start to see emotion through the shape of price. And I found that most interesting. I'm not sure if that answered the question that you had asked, though.
Yeah, no, I think people get involved in trading by either just kind of learning as they're doing versus, looking at traditional technical analysis books or doing their own kind of testing. Yeah, it sounds like it was kind of a combination of all that.
Yeah, it was, admittedly, without kind of trying to shit on technical analysis, it was a mess getting into it, particularly because you do it on your own. So as kind of mentioned, this isn't a full-time event for me. Do I manage my book full-time? Yeah. But I do have it managed. The pace of investing and trading for my accounts really is a function of how much time I can allocate to it. So it's not the day trading style. I mean, even swing trading is quite difficult, but most of what happens is predetermined with preset stops and preset profit positions. So most of the time, I'll open the accounts and I'll see what's happened based on previously set rules.
Right. And that makes sense, right? Because unless you are a full-time trader looking at noise, which I think a lot of intraday stuff tends to be, you have to kind of manage your time effectively in terms of doing your day job while markets themselves are open and not getting surprised in terms of your account value. Okay, so let's talk about where we are currently at, 6 weeks of market sentiment, euphoria, which I think is the right term to use. Now, the narrative is, of course, that breadth is widening. We'll touch on that. But I want to get your take from a trader's perspective on what's happened recently. I know you've been more on the negative bearish side. I've seen comments from people going out on your tweets, just like I see them on mine, where it's like, oh, you've been bearish and wrong based on just a few weeks, which may not mean anything in the grand scheme of things. But just talk about kind of your view on markets currently.
Yeah, you're right. I mean, if there's an immediate sign on potential sentiment, FinTwit's a great spot for it. I mean, I've been no stranger to recently getting blasted in my thoughts that have sustained a relatively bearish outlook. So I've and I should caution that it's bearish but bullish, and that's a change for me. So I mean, earlier in the year, I had maintained a pretty bearish outlook, and I had said for me, if the S&P 500 can't get over that 4,200 mark, I'm not interested in participating long. And what happened was it did cross that. That was through June and July. Leading up into the year, the breadth was poor. I mean, we've seen so many tweets saying that the market's been built on a small number of stocks, essentially carrying the indices upward. I still think that to be true. Breadth is improving, but it's really not that much better. When June and July kind of progressed, or as we're progressing through July, obviously we've seen a meaningful breakout. Where I had struggled, and you could argue that this is a miss on my side, I elected to not participate in the long side of the market, even though I had 4,200 marked as, hey, this is probably something different. It's likely not as bearish as I had initially projected through my thoughts. Hindsight's 2020. If I had, if you'd gone long at 4,200 and enjoyed the rally here to 4,550, that'd be fun. But the reason I elected to not participate was breadth was still, in my opinion, weak. And more than anything, that was the beginning of us being back into a greed-fueled environment. And I've recently written, nobody tells you to go buy greed and sell fear. Like nobody's going to get famous off that. That's why I elected to not participate, in the market. I do think that a meaningful correction from here in the indices wipes out everything that happened through June and July. And many participants that have decided to kind of start to go long here late, I think will find themselves quickly humbled. I do think we're in that everybody is in the pool moment. And I mean, I had you pinned that funny meme that I had generated using the AI from Midjourney, but that's really what the market looks like and feels like to me right now. It's a group of bulls, celebrating with the margaritas, and it's a party. You're oblivious to it when you're having fun. But I do think that music's about to stop.
Yeah, and I will say, this is a year where there's a lot more nuance than the headline averages would have you believe, right? I mean, we know about the Magnificent Seven, and again, the narrative of the breadth is widening, which I would question quite a bit. But I'd argue that the bulls and bears have both been right because it's almost been two totally different markets. After inflation, the vast majority of stocks are basically flat to maybe slightly positive, which in a pre-election year, at this point in the cycle, is also very abnormal.
I have to admit, I followed a little bit of the seasonality, knowing that the pre-election years are going to tend to be bullish, but I haven't allocated much thought behind seasonality or weight behind it. Aware of it, hindsight again here, probably should have paid a little bit more attention to it where we're at, but specific to kind of the bull and bear market that's kind of unfolded through 2023, it's whipsawed the initial part of the year. It's really just been the last 6 weeks that have been really fun for the long participants. Prior to that, I imagine it was frustrating watching new positions go slightly green, back to neutral, a little bit red, back to green. That's a frustrating place to be in and easy to just get exhausted. And I describe participants as being numb. A part of me thinks a lot of participants woke up here through June and July after, months of being numb. Instead of, waking up and recognizing that we're in that state of greed. The last time we were this greedy, I just looked at the name exposure index and the fear and greed index here that was posted on Wednesday. So I have to look at those two things. CNN fear and greed index, I think it's interesting just because it's easily accessible. It's a consistently published number. And the name exposure, This is the most bullish exposure we've had from active market participants since the peak of 2022. It's also the greediest we've ever been since that peak. The other conflicting thought I kind of had was, geez, it's approaching 6 weeks. When's the last time we were this greedy? That was 2019 that we were just before the COVID peak was when we were that greedy for that long. And I mean, we all know how that ended. But it's been a long time since we've been this greedy for this long. The sentiment positioning right now in the marketplace has me really thinking that much of the advance that we've seen here today is en route to being corrected. I lean right now to that being a healthy correction. I'm also comfortable changing that position as we get that 10 or 12% decline.
I will say I do think that the 2019 example is interesting from a sentiment perspective because you needed COVID to happen to break it to some extent. Like you always need to have an exogenous shock when you see sentiment that extreme, because the truth is extreme greed sentiment can persist, right? And arguably that's what creates manias and blow off tops.
100%. I mean, back in 2019, when I had looked at the data, and I should mention, my perspective was an easy way to kind of analyze whether markets are doing well or potentially not under the surface. But back in 2019, when that extreme sentiment moment happened in November, based on the CNN Fear Greed Index, the index rallied a strong 11%. I mean, from here, that would push us into all-time highs. But for one of the things that I had looked at also was breadth improving in 2019, and it was markedly in a big way. Sure, the last 3-4 weeks here, we've seen expanding breadth. I still argue small caps are not participating. There's certainly names to potentially keep on the watch list, but perhaps I have it framed or a story built in my mind that, if this market genuinely is going to reverse, that smaller grouping that's neglected participation throughout all of this year needs to participate. I mean, it's just, yes, the bounces have been big in terms of a percentage basis, but from the declines in a lot of these small caps, it's really, on a chart, it's a little bounce.
No, and I'm glad you mentioned that, because I keep going back to this point that this breadth argument is very nuanced, because the small to large ratio is not really picking up. So yes, there are more names you can argue that are rising, but the pace at which they're rising, adjusted for their beta and smaller nature, should be really outperforming large caps, and it's not. So it's not like a very high conviction sort of go aggressive into small cap type of move. It's just keeping pace.
I agree. I mean, the other data point to look at is you look at the two major indices, the NASDAQ and the S&P 500, both are trading well above their August highs. That was a key breakout moment. That's what took this index into a rally. You go look at ARC or IWM, and you're still below those August highs. That rate of participation, I mean, you said it best, is it's not pacing with everything else. The story that's been driving much of the gains, has been around AI. Is there value behind it? Sure. It is likely to change the world, but I don't know if it's in the way that we currently envision. I mean, I remember people getting cluttered up over the metaverse. Hell, I did at one point, thinking that there was an opportunity for something unique to happen here. And it's okay to get excited, but I think just need to take a step back and recognize where we are today in that cycle. So correction or not, healthy or not, I still going to stand pretty firm here. I think one's coming.
Okay, so you said, you didn't participate on the upside. And by the way, those that say, oh, you didn't participate, it's like, get a fucking life, because that's the way this business works. You have to take risks, which means you're going to be wrong along the way, meaning you might not participate, you might lose, but that's what being a discretionary or being a trader in general means, right? Because otherwise, just do buy and hold and call it a day. So let's play out some scenarios. Let's say, we're in a mania that continues, the melt-up persists, all these fantastical arguments around, the S&P going up, the 20-30% from here come true. Would you stay in cash? Like, what would cause you to say, you know what? Yeah, I'm bearish, but this momentum's so strong, I got to play it. Or would you just not play it at all and just kind of sit there?
I mean, I think right now, I still have money market funds that are offering very risk-free returns that are pretty easy. You got GICs doing the same. There's an option for money to sit and still accumulate 4 or 5%. For me, I'm going to elect to not participate in the market until we start to see some of this euphoria fade. I know it can last a little bit longer, perhaps, another 4-8 weeks. And that's a damn long time in the markets to watch things continue go up. But I just won't participate in it. I've played through euphoria before. It's easy to get lost in. And once you're in, perhaps myself as a retail participant, I think others too, maybe, You convince yourself to hold on longer than you need to. Even if you got rules in place, I think Euphoria is such a risky environment to play in because you will often break rules because it is exciting. Instead of a decline being considered as healthy, there's a risk that it flips the other way, but you'll buy it on the way down. If the euphoria continues, I'm going to stay out. And I know that has negative implications on portfolio performance. And I should also clarify something. I did miss, I'll say, the entirety of the 2023 rally that's kind of unfolded. But rewinding back to October, I had a fairly profitable trade that I posted about on Twitter in October when the markets created that bottom. It was a highly unpopular opinion to think that a relief rally could occur. I was a proponent of the market rallying at least towards the 4,000 mark. And I fortunately was able to close the trade out before the end of the year. Part of that, I mean, he could have held on, but I mean, that's okay. I captured a portion of it. Are we materially higher now since then? Yeah. So there's been some that's been left on the table, but that is going to happen. So from a long perspective, until this euphoria fades, I'm not interested.
So the next natural question would be, well, then if it's not from the long perspective, why not short? Now, I'm very public about my views on shorting. I don't believe it works over time. Yeah, sure. Some people might get it just right? Because there's always a degree of luck on timing. But why cash as opposed to a directional bet?
I mean, euphoria is another terrifying spot because things can go up irrationally. I don't think many need to look further than NVIDIA. And I mean, shorting that or shorting the S&P 500 has been extremely unprofitable throughout this rally. So unless you're willing to, and I think it's okay to potentially take one at a smaller position size, it's just not, it's not the way I want to drive my portfolio forward by betting on a decline occurring at a certain time. That's just not typically my style. Will I, take a small short here and there? Yeah, but it's got to work pretty quickly. If I don't start to see positive performance within 3 weeks or so, it's likely to get caught into a more damaging position.
Why do you think that people automatically assume that if you're bearish, you're short? I mean, is it a function of just very simplistic thinking by retail traders? I mean, I often wonder why that's the automatic assumption.
Yeah, I mean, it's funny you bring that up. I think last week in one of my tweets, somebody had suggested that I full port my portfolio short against the S&P 500 if I really believed what I was tweeting. I mean, that's such a delusional thought to take an entire portfolio and position it against one idea because I tweeted that things should potentially come down and cool off. I don't know what it is. I think many participants who suggest going short haven't gone short themselves or haven't been burnt to see how fast it can unfold. It's not fun, and I've definitely been there. So I think lack of experience would be my guess, or it's easier to stay short than actually go short.
Yeah, no, I think that's right. The lack of experience, and because you were on the retail side and have done this longer than a lot of the newer traders that came in post-COVID, you've seen and experienced that. Whereas it's true, most people's view of how to think about trading markets is a function of when they start, not a function of big data that confirms an idea. And I'm with you. Listen, I was very loud on the melt up argument in October, like you, right? In at the end of the world is the bull case is what I said repeatedly. And then, December was a high risk period, fifth worst December in history, then back to melt up pre-election. But, even my own strategies have been, risk on. One of them flipped recently to risk off. But I'm bearish, even though, the strategies sequencing wise are still saying equities are, maybe okay here, but we're getting closer. At what point would you say, let's assume there's a correction that happens. What would cause you to allocate and deploy that cash? I mean, are you looking at specific percentages? Is it one of those things where it's like the definition of profanity, you'll know when you hear it? I mean, what would be sort of the entry point for you?
Yeah, so I guess I'll start with two thoughts. One of the things I had gone back and studied was past corrections. Is there anything in my toolkit that I use today that would be helpful in identifying when a reversal is real? Not necessarily saying, hey, this is the bottom, but saying it's most probable that the bottom you saw is in. And so I gone back and looked at essentially all of the major corrections that occurred in the S&P 500. And I said, okay, I've noticed a small trend. When price is able to trade 5% above the 200-day exponential moving average, so it's just an exponential long duration moving average, it's most probable that the bottom you've seen is in. And so the index did that in June. And I hesitated really tweeting anything about it. One, because it kind of, nullifies some of the opinion I had about a further decline. But then second, I just wasn't sure if it was going to be consistent. But it did that through June and July. So it flipped my position to saying, okay, the next pullback of material size is one that I'm interested in potentially purchasing because, based on my study, the October low is potentially it. So what I'm looking for right now is on the S&P 500, if I did a basic volume profile, so not volume by time, but volume by price, there's two key nodes that stand out. And I think what you'll find is one of them's at around that 4,100 mark, 4,120, and the other one sits at around 3,950. If you look at the chart, those are both key breakout points. And I think you've got this idea pinned in the nest here. What I'm looking for is for the index to pull back into one of those spots or near that spot. That's when I'm interested in potentially starting adding exposure onto the long side, both in the index and then also into the small caps, because I do think if a genuine reversal is underway, and this is it, I've accepted the fact that I missed a portion of that rally. That's okay. But I can catch the other piece of it. It's going to continue to the upside. So that 4,100, 3,950 area, it's a pretty steep decline from here. I think late participants would be humbled by it. And I do think you would see that euphoria, I think, wipe away relatively quickly. So that's kind of the two spots I'm looking at right now. And it's that volume profile. So volume at price creates price memory. People will remember. Those that went long, we'll see positions start to get back to neutral and say, okay, potentially a good opportunity to have. And that won't be the late participant. That will be the one who bought the breakout.
Okay, now that word memory is important because that is often the argument for why support and resistance, tends to work, right? There's memory around certain prices and that creates certain buy or sell decisions. Now, people think I'm anti-technical analysis. I'm anti-technical analysis that's not back-tested, right? I think a lot of people kind of reference things that don't have any true predictive power. There is something to support and resistance from what I've seen testing-wise, but you and I both know there can be a lot of whipsaws and false signals there, and everything works until it stops working, right? So I know you like to keep things basic and simple from a technical perspective, which, by the way, is the preferred way of looking at markets, because the more convoluted and the more signals you have, the more there's analysis paralysis. But aside from support and resistance, are there other things that you will look towards as, confirming indicators?
Yeah. So, and maybe it doesn't qualify as full-on technical analysis, but one of the things that I'd mentioned, I'd gone down the rabbit hole of Elliott wave at one point. And one of the things that really stood out to me in that period of study was just the correlation of sentiment. So, despite conditions changing, news changing, the stories in the market changing, the pace of FinTwit changing, we tend to respond and react in a very, I want to say, predictable way through moments of fear and through moments of greed. So I do consider where the sentiment barometer is. And I use the CNN Fear and Greed Index just as a general start. I do have a customized one that I use on TradingView that just incorporates a little bit more data, and it's a little bit of my own. So I do incorporate that, and typically just moving averages. That would be it. It's a very, very basic rudimentary technical analysis, but I do think that when you do get price trading above an area that hasn't for months, and in our case that was clearly visible. Once we broke above the those August highs, you can see the S&P 500 took off, and the same happened with the Nasdaq. So it is simple in that sense. It really isn't much more complicated. I do often like to include some detail on retracement percentages, but again, you said it best: paralysis by analysis. And I do think that is one of the drawbacks of those that do practice wave theory. It is so easy to get lost up in the minute details. I've pared back the, I guess, call level of detail that's included on a chart, because over time I've learned it wasn't benefiting me, and I was often making too many decisions at a pace that I couldn't sustain. So, and that's something that I recognize needs to fit the time that I'm able to allocate into markets.
I'm curious if you see any parallels from your early journey, 12, 13 years ago with trading to the way that people view trading today. Listen, when everybody's new and they have early success, they tend to be overconfident and then, not knowing if it's skill versus luck that causes the gains, or just a cycle that happens to be when they're launching their approach. Post-COVID, there's been a lot of new entrants, obviously, and a lot of younger players have come in. Do you think that the journey that you had is typical compared to what you see on the FinTwit side at this point in their own respective, I'm talking in broad strokes here, own respective journeys, or is there something that's different either because of no commission day trading or social media that makes the learning journey for a newer trader different from when you yourself did it, 12 years ago?
Yeah. So I mean, I have to pay respect back to when I joined the market. There's a part of timing that you don't get to control. You join when you join, and for me that was, once I started to have capital that I could invest and make decisions with on my own. So I mean, entering the market in that post 2008 bust era, I was looking up, and I really, I don't realize how fortunate I was until many years later to have started to participate in that market. So it's been a super positive experience for me. But the group of participants that joined the 10 years prior, they were whipsawed twice. I mean, it took them 4 years back to back off of the 2003 low and same with the 2008 low just to get back into all-time highs. So there's some perspective there. In terms of newer participants, the thing that stands out to me today is, even FinTwit's advanced the pace of information, easy to potentially get lost in, but there's also significant value. I mean, Twitter can be one of the best timelines for financial news in the markets if you can curate your following and then try to modify and minimize the noise on that. The other thing I've noticed more particularly as I even analyze certain moments in time is the pace of movement is extraordinarily quick. When things break out, they tend to go up. The staircase is steeper. So there's been that, staircase up, elevator down, general, kind of thought in the marketplace. The staircase today is way steeper than it ever was on the way up. And same goes with the elevator down. Like when that elevator goes down, it's in free fall. So I think that's probably one of the biggest changes is the pace of the game. I almost hate to call it a game, but I often do feel it is that, has changed in terms of how fast it's happening.
And the effect of that is what? Is it that people just have to or consider taking faster trade or maybe having more turnover? Or is the effect of that it also introduces maybe more noise because the faster something is, the harder it is to kind of see the underlying signal?
I mean, I don't know if I have a perfect answer to that. A part of me thinks of the most recent, when the COVID crash happened. By the time folks were able to look at their portfolio, and I don't mean those that are actively in the market every single day, but the average retail participant or even older participant, by the time they got their Q1, Q2 statements, I mean, the bottom was in, right? So that pace is extraordinary. I'm not too sure I have a perfect answer for that question today.
Yeah, it's just something I often wonder about, just sort of market structure dynamics, and if the world is noisier today than ever before, right? Just the information is faster, but it's harder to assimilate, right? So the more it comes at you.
Yeah, it's not easy to differentiate, and that's kind of why I like technical analysis so much. It really distills everything down into price. And you can supplement it with news. And I think it's very healthy too, especially on long ideas to, consider if you're going to hold a stock for an extended period of time or even trade it for an extended period of time. I think it's okay to follow the news and even potentially get a little bit caught up in it because that creates some natural conviction. Most people will say you should try and, fully remove emotion from the decision-making process. I don't know if I'm fully there. I think to size in for some of the bigger trades there, that excitement, supports conviction. And same on the other way around. I think it's okay to recognize, when you're in a position of fear, but that shouldn't necessarily be a scenario where you panic sell. Just more food for thought.
How closely, you had mentioned news flow before, how closely do you watch, or pay attention to financial media? I tend to be more like you. It's more of a contrarian kind of signal, right? So I put out that tweet at June 16, which was the first low last year, when I happened to see on CNBC markets in turmoil. And it's not a coincidence, but it really is true that when you see markets in turmoil on CNBC, that actually tends to mark a short-term bottom, right? Because the reality is they're reporting what has happened, not what will happen, right? Which I think is often missed by audience members. But do you pay attention to sort of headlines like that, or is it just noise to you and independent of your own view?
No, I secretly have there's a love for those headlines. They just make me laugh. Sometimes they're going to be right, but yes, I do enjoy the headlines because it is a representation of the retail participant, sentiment. If I wasn't looking at the CNN Fear Greed Index or my own, you can gauge sentiment just based on those headlines and be pretty accurate with it, right? Markets in turmoil, brand new bull market. I do find it very funny. So as a general statement, I keep up with the news on a daily basis. There's at least, there's some time allocated every day to keeping up with the news. but the majority of my work is done on the weekend. So I'll spend some time on Saturday, actually focused on collecting some of the top headlines that occurred. And on Sunday, I'll really just kind of consolidate my thoughts in the morning and publish that into a Substack. That is, and that's as much of the time as I'm able to really afford into managing my own book.
Although it's interesting, I'd argue that's actually the best way to do analysis, right? Is to do it when the market's closed, right? I mean, you have a clearer head when you're not looking at prices moving, even if it's just short-term movement versus a longer-term trading style.
It is way easier to have a clearer thought when those markets are closed. I'm not a proponent of this whole potential 24-hour business that's going on. It's what's I'm full disclosure not a crypto or Bitcoin enthusiast, so I've also avoided that market like the plague. But I don't know how they do it. I don't know how they survive the 24-hour trading lifestyle. That's not for me. I'd be way too stressed.
I am. I'm already stressed during the day, so the last thing I want is to be stressed after hours. Okay, so I do think it's important for anybody that considers themselves a trader to diversify away from their own trading, right? So, I tend to favor more active, tactical approaches to markets, but that's not to say I'm anti buy and hold, right? Because it's like diversification of strategies, which has been a theme actually pretty much all day on some of these spaces I've been doing. Do you have some, investments separate from the cash position that you wouldn't trade that you just say, you know what, I'm going to stick to it? Or is the entire portfolio active trading?
I look at the entire portfolio as actively managed. And I mean, for me, it was last August was kind of probably the largest move I had made in my own portfolio management in that 12-year period is I started to exit the market. I had made the thought that was an appropriate time for me to exit the market, and the lower was potentially in. I felt like a genius by the end of the year, a lot less so now. But no, I look at the entire book as actively managed. It's not all in actively, being a Canadian. Some of our funds you're locked away in from with something that you could withdraw upon on a daily basis. But I look at the entire piece as an aggregate, despite multiple accounts under it.
So speaking about being Canadian, I assume that based on the accent, but because we actually haven't talked about that. But I talked to a lot of people that are in Canada, and they obviously trade U.S. markets. I am curious to hear your thoughts on are markets different outside the U.S. in terms of the way they move versus inside the U.S. So versus the Canadian stock market, do you find there are big differences in the way those markets move compared to ours when you obviously adjust for sector composition, or is a stock a stock?
That's a funny question. I mean, as a Canadian, funny you mentioned I have an accent because I obviously live day to day, not accepting that I have one. One of the things I always consider, obviously, is the USD CAD conversion rate, which has been, as an active participant, the majority of my funds are allocated in US dollars. So when the US dollar is performing well, that's a great position for me to be in from an investment perspective. So that's always a consideration. In terms of the TSX or the Toronto Stock Exchange, so energy weighted and so bank weighted, because I choose not to participate in the energy markets, being that's what pays the day-to-day life. It's just not a market that I look at. So with the exception of the banks and maybe some small allocation there, I don't know if it's fair to say a stock's a stock. I mean, the Toronto Stock Exchange did enjoy its moment of euphoria when the cannabis boom took over back in 18 or peaked in 18.
By the way, I give you credit because the second time you mentioned that point that you're in the profession from on the energy side of things, but you don't want to play those stocks. I think a lot of people underestimate how much risk they take when they're in a profession, in a particular sector or industry, and then trading in that sector and industry because they think they have an edge, but actually, gets them into concentration risk for their own lives.
Yeah. And I mean, are my insights in the energy world better than other segments? Probably true. I think one of the things I've realized is the finite details you get by living and working in an industry are often not really so applicable to the day-to-day ranges of a stock price. Like the narrative that drives an upward move, it needs to be simple and understood by a large body of people and funds to actually make movement. And that's why they're one of the reasons I think the whole AI concept has taken off so well. It's easy to understand. And ChatGPT made it easy to understand because it was accessible to everybody. That's a story that you can fall in love with and get blinded by euphoria with pretty quick. So the same can happen if you're living and working in an industry and then choosing to trade, the extra edge that you think you may have. Whereas it's such a minute detail that few participants will really ever know or understand. And same with funds. that it's really not an edge. It's just a cool piece of information for you. But more than anything, it's hedging risk. That's the biggest piece for it is there's risk exposure if you just double down on investing in the same industry you're working in.
I think that point is very well articulated, right? It's like the things that cause prices to move have to be the narratives which the lowest common denominator would understand, right? So complex investment theses tend to not become manias. But if it's something that can be put into a soundbite, right, that's where you get the public, the manic behavior, the retail, the uneducated speculators, the blow off, and then ultimately the collapse.
Yeah. I mean, we don't even need to look further than the whole AMC and GMC thing. I mean, we've got Netflix series coming out on it. I mean, if the basis can be grabbed by everybody, yeah, mania unfolds fast. It's fascinating to watch. I mean, anybody from the Canadian side of the market, and even I guess the US who had enjoyed some of the euphoria that occurred in the cannabis sector, it was easy to get caught up in too. So, and I mean, we don't need to highlight the death that has occurred to both of those segments, but there's none of those charts look great today. That euphoria is fully removed.
Right, and I've used that line before. It's like the one commonality across major tops and major bottoms is overconfidence, right? And you can see that in a chart based on, to your point, the steepness of the staircase. Let's talk about position sizing for a bit here. So things start going down as you expect they will. You're going to start deploying. You're going to do it gradually, dollar cost averaging. You're going to max out a certain weighting. How do you actually manage the portfolio weights of your trades?
Yeah, so I'm okay to take a small number of positions. So I don't mind having a concentrated portfolio, which can mean some individual ideas can get up to, that 10, 12% position size of total portfolio. I'm comfortable doing that. But it's certainly not going to be in a single swoop this time around. The primary basis for that is I am expecting, this potential correction that I talked about to be of health. I've been wrong before and I'm going to be wrong again. It would not surprise me if I was potentially wrong on my next call that says, hey, things should come down. What if they keep going lower? So for me, it's sizing in and it's not averaging down. So once I build a position, say I open a position, I've shared two ideas. I like Unity and I like Snapchat. So I'm comfortable opening up a position, but say today I buy Snapchat at 13. My next purchase of Snapchat cannot occur below 13. I need to see positive growth in that position for me to size into it. So I don't average down, I'll average up. And that will prevent me from, essentially creating a position on the way down, despite potentially larger returns. I manage the trade with much more controlled emotion when it's in a green. I'm comfortable to split a 10% position across 5 orders. It's typically kind of what I would do.
I want to go back to the idea of noise and again, you being in Canada, right? Because I think if you're trading international markets, you can't help but maybe have your own sentiment be skewed by what's going on domestically. I mean, I think that's perfectly natural to think in those terms. And home bias is very real, obviously, in terms of the way that people view everything in the context of investing. I'm just curious, maybe a side note here, but are the doom and gloom narratives around Canada and the housing market there? I'm just curious, are those overblown or you think there's some validity to that? And if there is some validity to that, does that impact anything? Right? I mean, I've had a number of these spaces where they make the point that you're going to have a lot of these resets on the mortgage side that would be really problematic.
Yeah, I mean, I could talk a little bit about it. So a lot of the real estate that shows up on FinTwit, or even real estate Twitter, if that's what they call themselves, focuses on really 2 areas in Canada, and that's the East Coast and then the West Coast. So East Coast would be the Toronto area. West Coast would be the Vancouver area. Both markets have experienced massive rises in prices in houses over the last decade. In the last 2 years, having real estate prices go up 20, 30%, that's a real deal. Is it sustainable? I mean, heck, I have no clue. The interest rate thing is real. So in Canada, a lot of renewal terms are only 5 years. So a lot of folks here in the world are going to be signing up for a little bit of shock when mortgage renewal time comes up and you're renewing from a rate that was, say, 2-3% into a rate that's potentially 5 or 6. And potentially, you're not really seeing the upgrading of homes per se or move up homes occurring as much as we have historically, at least in the areas that I live in. But I'd like to say in the energy industry, I kind of live in the bubble zone right now. Not the massive bubble zone of the West and East Coast cities, but a little bit secure. where we're at. Does it convert into trading? I mean, a little bit. I mean, I was a little bit pessimistic thinking, Jesus, this whole thing's going to crash. It hasn't. Nor do I want it to, because I'm a huge benefactor of it not crashing.
That I'm glad you say that's an important point, because like the reality is that the perma bears, they shouldn't want to be right, right? Because it hurts them, as much as the perma bulls, right? Doesn't matter if you're short, when the world's collapsing, it's not a good thing for anybody. But that point about trying to avoid how it impacts your trading, I think is important, right? Especially if you're trading outside the US.
It's and again, the REIT or the real estate market hasn't been something that I've typically shopped. So it dominates the news flow. But yeah, I don't know. Is it as doom and gloom as they say it is? I don't think I'm probably the right person to speculate. But those are some of the thoughts I've had. There is some real bubbles, but they've been bubbles for some time, and I have no clue how much longer they're going to last, or if they'll get bigger.
Right, that's the big one, right? The bubbles have a funny way of getting even larger than even the most bullish people tend to think, which is the blow-off phase. Which, by the way, is also another interesting part, because I would argue that we haven't had this sort of traditional capitulation in equities last year. It wasn't sort of it wasn't a VIX spike in a meaningful way that typically ends a bear market. Maybe this time's going to be different. Typically things tend to end with a bang, not with a whimper. I tend to be more on the negative side because, again, I keep going back to I think there's a credit event out there, which, if I'm right, ends the bear market, which again assumes I'm right about the bear market. But if you look at history, most bear markets tend to finish with a waterfall, shock, scary decline. I don't know if you'd qualify what happened last year as just that.
Yeah, I don't, and I was on the same boat. It was one of the reasons. It's still potentially a reason why. It was one of the reasons why the October lows for me at that time. I kind of thought, okay, it's going to go lower from here. We didn't get that capitulation, or we didn't see it. I don't know. I still think there's an opportunity for capitulation to potentially happen, above the October lows. Be an interesting event. It would just be the pace of the decline that would drive that in a scenario like that. Yeah, you're spot on. That didn't occur, and I think it threw off a lot of people. For sure, me.
Yeah, no, 100%. Tom, for those that want to look more into your way of looking at markets, you got your Substack, lay out what that URL is since it's a podcast, but also just talk about, where other people can find some of your analysis.
Yeah, so you'll find it on two spaces. So it'll be here on Twitter. So I send a longer note on Sunday, that a longer form tweet on Sunday that really captures just the general thought or potentially an idea for that week. But the Substack is the longer format version. So that's linesonachart.substack.com. I rate that every Sunday. So usually it'll hit your inbox around, I guess if it's Eastern time, probably about 11 o'clock. So just before the lunch hour. But for us here on the western side of Canada, you'll be probably having your second cup of coffee. So and that's every week. I've been consistent with that since last August. So we're that little newsletter is approaching about a year in commission, and it's been a fun one. A great way to just kind of consolidate thoughts and just get some discussion going around where markets are going or the way that I look at them. But it's a very simple approach. One of the things that offers to an audience that might not be, so keen on technical analysis, it's a simple way to incorporate it and think about it. And I think I do a good job of distilling it in a basic way that it still allows for meaningful insight on which way to go. But like I write to everybody that clicks that subscribe button, I'm going to be right, but I'll also be wrong. And if you follow me long enough, you're 100% going to see both sides of it. And for whatever reason, FinTwit struggles with that a lot. For whatever reason, the Substack community doesn't. So there's my little disclaimer.
Yeah, that's been my experience with Substack too. Yeah, everybody, please make sure you follow Tom. Check out his Substack as well. Tom, I'm glad we finally got to connect here.
Yeah, super. That was a ton of fun. I appreciate the time you've afforded and the opportunity on your spaces here. So thanks, Michael.
Very good. Thank you, everybody. Thank you, Tom. Cheers.